This is your technical update from the LMAX Exchange Research and Analytics Desk for Wednesday, June 8th, 2016. Euro dollar. So despite this latest bounce in the euro, the overall price action remains quite bearish, with the market having broken down recently below some key support at 112. As such, look at this rally as corrective while it holds below 115 on a close basis. You can see if you look back that there's a lot of internal resistance up towards 115, and unless we close above that level, there's no point on getting bullish this market. Look for any rallies to stall out ahead of that level in favor of the next downside extension all the way back down towards 110.98 and below. If we do see a close above 115, that will shift the structure and put the pressure back on the recent 2016 peak at 116.17, which guards against more critical resistance at 117.10 further up. Sterling dollar. So cable continues to chop around. The key levels to watch right now above and below are 147.70 above and 143.33 below. Until we see a break on either end, there's no clear directional insight. If we see a break above 147.70, that would suggest that the market is putting in a more significant medium-term base, while inability to do so followed by a break back below 143.33 will open the door for a breakdown towards psychological barriers at 140, which guard against that 7-year low from earlier this year at 138.36. Dollar yen. So dollar yen continues to be pressured to the downside with the downtrend firmly intact. The market is now focused on potentially retesting and breaking below the 2016 low from May at 105.55. If we see a breakdown below that level, it could open the door for the next major downside extension that takes us down towards 100. At this point, any rally should be very well capped ahead of the 109.50 area, while ultimately only back above 111.89 would compromise the bearish outlook. Euro Swiss. So Euro Swiss has come back under some intense pressure over the past couple of sessions, but the market has stalled out ahead of some key support at 109.55. Ultimately, the market has been trading sideways to higher over the past several months, and so with the market holding above 109.55 and even 109 on a close basis, there is risk for another higher low ahead of the next upside extension beyond 111.30 and towards a retest of the yearly high at 112 further up. But if we see a breakdown below 109, that could compromise the outlook and expose critical support down at 108 further down. Aussie dollar. So Aussie continues to extend its run higher after breaking down to a fresh multi-day low at 71.45. At this point, there is risk for additional upside towards next key resistance in the form of the 61.8% Fib retracement off the 2016 high to recent 71.45 low move. But any additional upside beyond there should be limited, with the market ultimately favoring the downside for a lower top and fresh downside extension back below 71.45 and towards that 2016 low at 68.27. If we do see a break and close above 75.70, that could delay the outlook and force a potential shift. Dollar CAD. So dollar CAD continues to extend setbacks after rallying up towards just shy of 132. At this point, setbacks could still be very well supported as the market shows the potential for a more meaningful base, but ideally the market will need to hold above 127 on a close basis to suggest that it's looking to put in a higher low above that 2016 low at 24.61 ahead of the next major upside extension beyond 31.89 and towards 135 further up. So on Wednesday, pay attention to 127 to see that the market can establish if the market can hold above 127 on a daily close basis. Kiwi dollar. So Kiwi continues to extend its rally out from recent lows at 66.75, but with the market trading back into some critical resistance around 70, there is risk for another topside failure as it continues to show signs of stalling out up towards that psychological barrier. The 2016 high comes in at 70.54, so it would take a break back above that level to force a shift in the outlook. Until then, look for another topside failure and bearish reversal. A break back below the recent low coming in on Tuesday, which came in at 68.93, would do a good job of strengthening the bearish outlook and accelerating declines back towards 66.75. SPX 500. So the S&P 500 has recently put in a fresh 2016 high around 2120, and clearly the market is now potentially focused on a retest and break of the record high from 2015 at 2133. At this point, a break back below the recent low that we saw at 2084 or 2085 would be required to take the immediate pressure off the top side. Gold. So gold continues to show just how well supported it is on dips following that latest breakdown that we saw in the previous week to 1200. At this point, this choppy price action that we've seen going back to February of 2016 is classified as a bullish chop and a bullish consolidation ahead of what should be the next major upside extension beyond the 2015 peak at 1307 and towards 1400 further up. Only back below 1190 would compromise this constructive outlook for gold.